Infra Limited Q3 and 9 months FY26 earnings call hosted by Kirin Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshal Ghanshani. Thank you, and over to you, sir.
Thank you. Good morning, everyone. On behalf of Kirin Advisors, I welcome you all to the conference call of Shri Keshav Cement and Infra Limited for Q3 and 9 months FY26. From the management team, we have Mr. Venkatesh Katwa, Chairman, Mr. Vilas Katwa, Managing Director. I hand over the call now to Mr. Venkatesh sir for the opening. Over to you, sir.
Yeah, good morning, everyone, and welcome to Shri Keshav Cement and Infra Limited's Q3 and 9-month FY26 earnings call. I sincerely appreciate your time and interest in joining us today. Shri Keshav Cement and Infra Limited is engaged in the manufacturing of cement and the generating and distribution of solar power in Karnataka. Our cement plants operate from Bagalkot district, supported by 40 megawatt solar power facility at Koppal. Out of this, approximately 25 megawatt is utilized for captive consumption to meet the entire power requirement of our cement plants, while the balance 15 megawatt is sold in the market. We serve North Karnataka, Coastal Karnataka, Goa and parts of Maharashtra through our established distributor and retail network. Before I move to present the company's financial performance, let me briefly share our operational progress. With the new kiln now stabilized and operating consistently, our focus has been on improving the capacity utilization, strengthening supply chain efficiencies, and deepening our market penetration across key regions. We continue to work towards expanding volumes, enhancing dealer engagement, and ensuring better availability of our products. Our integrated solar operations provide a structural cost advantage, enabling us to remain competitive while maintaining healthy operating margins. These initiatives position us well to capitalize on steady demand from infrastructure, housing, and commercial construction across our core markets. So let me walk you through our financial performance for Q3 and 9 months FY26. For the 9 months ended FY26, the total income increased by 35.81% year-on-year to about 116.31 crores. EBITDA stood at rupees 29.28 crore, reflecting a growth of 66.85%, with EBITDA margin expanding to 25.68%, an improvement of 454 basis points. PAT for the 9-month period was 3.23 crores compared to loss in the previous year, reflecting a clear turnaround in overall profitability. Earnings per share improved to rupees 1.85, supported by strong utilization levels, disciplined cost management, and enhanced operational stability. In Q3 FY26, the company reported total income of 38.69 crores, registering a growth of 33.22% year-on-year, supported by improved realization and sustained cement dispatches. EBITDA for the quarter stood at 10.5 crores, reflecting a growth of 63.1%, while EBITDA margin improved to 27.68% compared to 22.9% in Q3 FY25, marking an expansion of 477 basis points. Cash profit stood at 4.03 crores, which is an 85.9% jump year-on-year. The term debt reduced from 188 crores to 159 crores, reducing by around 15%, which will continue to do so. In fact, the repayment obligation next financial year will reduce by around 16.4%, owing to closure of 3 terminals in FY26. Cement continued to remain the strongest contributor to our performance, both in terms of revenue and operating profitability. Higher dispatches, better realization, and stable kiln operations have strengthened segment momentum through the quarter. With construction activity remaining steady across Karnataka, Goa, and Maharashtra, our focus remains on leveraging this demand through deeper market engagement, stronger channel relationships, and enhanced brand positioning. cement will continue to anchor our growth trajectory in the coming quarters. Looking ahead to the remainder of FY26, we will continue to prioritize disciplined execution, optimal utilization of assets, and further strengthening of our dealer and retail network. Our objective is to sustain operating momentum, improve margins through better leverage, and enhance our market presence across existing and adjoining geographies. With steady cement demand and cost stability offered by our captive solar power model, we believe we are well positioned to deliver consistent and sustainable performance. So before moving to the Q&A session, I would like to extend my sincere thanks to all our stakeholders, partners, customers, and employees for their continued support and confidence in the company. Their contribution remains central to our progress. With this, I am pleased to open the floor for questions. Thank you once again for being with us today. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants may press star and 1 to ask a question. The first question is from the line of Anurag Jain from Oakland Capital. Please go ahead.
Yeah, thank you for the opportunity. So, sir, I wanted to ask, what is the clinker to cement ratio currently, and how will it improve post modernization?
So currently, clinker to, for 1 ton of clinker, we are able to produce around 1.6 tons of cement, 1.6 to 1.8 tons. So we are expecting to reach around 1.9 to 2, not in this quarter, maybe in a quarter down the line from this point onwards.
Okay. And sir, how much power cost savings annually come from 100% solar usage model?
So directly, solar presents almost 35 crore EBITDA, if completely taken as an independent vertical. So my production cost is around, let's say around, if for 100% utilization of solar power is the question you have. So for around 6 crore units, saving of around roughly about 4.5 rupees would translate to around 25 to 26 crore actual savings coming from solar usage in the cost itself, in the operating cost.
Okay. And sir, will there be any risk to this solar generation efficiency due to any regulatory changes?
As such, we have a regulatory benefits given to the solar plants, which was commissioned in 2018. And those regulatory benefits will continue for 3 years for 1 plant and around 7 years for another plant. As of now, there are no regulatory challenges happening, and I don't foresee any kind of regulatory changes, coming in future, which could hamper our the cost structure. After a few years, there are some charges which will be applicable, but which is common for everyone all over India. So it would be a common cost shared by everyone and not specific to persons using only captive solar plant.
Okay. Okay, that's it from my side. As of now, I'll join back with you if I have any more questions.
Thank you.
Thank you. A reminder to all participants to press star and 1 to ask a question. The next question is from the line of Sakshi Shinde from Shah Consultancy. Please go ahead. unmute your line, Sakshi ma'am.
Yeah. My question is the company exposed to the price volatility from large players' discounting strategy?
Yes, to a large extent, every cement player in the industry will be exposed to the challenges faced currently by a lot of consolidation. So, I would try to address this question more by going into the southern market. See, the South and East India regions experienced sharpest price corrections, with the average cement price declining by 2 to 3% quarter-on-quarter in Q3 FY26. Cement demand was pretty much weak in the first half of Q3 due to extended monsoons and festive disruptions, but improved meaningfully towards the latter part of the quarter. In summary, Q3 FY26 South-based manufacturing experienced compressed margins, with specialized, some top-level players generating around 250 to 600 rupees EBITDA per ton, heavily impacted by overcapacity and weak pricing in the southern market. So yes, so because the larger players are competing and there is aggressive pricing strategy used by some top players, it has to some extent impacted all the other players, including us.
Okay. And my last question is, what competitive mode exists beyond the green energy usage?
So the biggest strategic benefits our company has is, which is in fact helping us to grow. In fact, we grew at around year-on-year in quantity by around 32%, whereas South struggled with -3% or -4% growth year-on-year. Now, the biggest advantages what we have is we are in close proximity to the consumption market, which reduces the logistic cost, which has been our biggest competitive advantage to us. And also being located at the Karnataka-Maharashtra border, so we have deviating purely being addressing only the southern market. And now in the Q3, we have entered the western market through coastal and southern Maharashtra, and we have got a new access to these kind of markets, which previously we were not addressing to. Also, we have added GGBS, which is granulated ground-based slag, as a product which is used by large national highway projects, which is helping us to cross market into cement. So, one biggest benefit, as I would say right now, which I do not see anyone having, any other industry having in our region, is the addition of GGBS as a product. So once the customer uses a product, it is a natural inclination to buy our other products, which is cement. So these are the strategic advantages we have right now, which is helping us to compete and growing at a faster pace compared to the southern market averages. Thank you, Sakshi.
Oh, thank you, sir.
Thank you. The next question is from the line of Pooja Mishra from JK Capital. Please go ahead. Pooja ma'am, you may unmute your lines.
Hello.
Yes, you're audible.
Yeah. Okay. Yeah, so I have a few questions with me. Our Y-on-Y total income growth is around 35%. Even EBITDA is growth. So what is the reason behind this negative impact?
So I did not understand the last. Yes, there is a growth of around 33% in top line year-on-year. EBIT also, there is a growth of around 53% in absolute terms. So the growth is mainly driven by the factors like our new kiln is being stabilized, and being solar means that we have a high dose of fixed cost compared to variable cost. So every increase in the dispatches is giving us a higher contribution margin, and which is what I mentioned in addressing the previous question. Even though the southern markets are barely having -2 or -3% growth year-on-year, we delivered 32% growth only because of aggressive marketing and addition of few products, which is helping us to boost our cement sales to.
Yes, correct. And in quarter, we reported a loss. Even though
Are you are you talking about
yeah.
are you talking about PAT?
Yes, yes. I'm asking about that.
So, Pooja, the reason why it shows negative is because there is something called as deferred tax liability, which appears because of a huge difference in the depreciation on the books and on as per income tax, which is basically an Ind AS adjustment, but not a cash expense as what it portrays. In fact, it is an advantage to the company. Because of that, there is a huge, cash tax liability reduced because of that is a kind of a promotion given by the, by the government, you would say. Otherwise, actually, it is not a negative PAT. It is only because of certain non-cash adjustment figures what we put due to Ind AS requirements. It appears to be negative.
Fair enough, sir. Also, I have a few more questions. Like, what was cement volume growth in 9-month FY26 versus industry growth specifically in Karnataka?
So, the data that I have is only for the pure southern region, like Karnataka and Telangana. So, the data that I have right now with me is on volumes. There is even though there is a negative growth in EBITDA, the volume there is about 4% growth for southern markets, but Keshav Cement has performed at 32% growth in volumes.
Okay. And can you share blended realization per ton trends over the last 3 or 4 quarters?
So blended realization has remained almost stable. Like if I compare from Q3 FY25 to Q3 FY26, it has hovered between 3,300 to 3,400. 60 had peaked out in Q2, and again it has come back to around 3,350, 3,400 right now. So absolute CAGR growth in naked cement rates is hardly 1%. That is again mainly because of southern market showing overcapacity and compression in the margins. In fact, this quarter 3, with the increased sales, we would have expected a higher profit margins, but then petcoke prices increased by almost 20% year on year, which was not very much expected.
Yeah, okay. And what is the trade versus non-trade sales mix, and how does margin differ between the two?
So trade versus non-trade. Trade, in our case, is for non-trade, when we talk about direct to the consumers, the prices may be a 2 or 3% difference. Otherwise, there's not significant change. Because if the non-trade, if they can find the better prices, they would go for outside market itself. Being a small plant with a small capacity, we have not kept a very substantial difference. A non-trade typically will be 1 or 2% lesser.
So, that was my last question. Also, I'm joining your con call for the first time, but I keep hearing that you regularly, host con calls, even if there's no positive part, which is good. This shows your sincerity to us investors. Good luck, sir. Looking forward.
Thank you, Pooja. Appreciable.
Thank you. Participants may press star and 1 to ask a question. The next question is on the line of Raj Shah from Shah Ventures. Please go ahead.
Yeah, hi. Good morning. So, basically, what happens to margins if cement prices decline by 5 to 7%?
Yeah, good morning, Raj. I couldn't get the question. Market what shift?
Yeah. So I repeat my question. What happens to margins if cement prices decline by 5 to 7%?
So, it's, typically what we would see in these industries with 5 to 7% decline, it would be a hard hit for any cement industry. But in my case, because of high usage of green power, almost 100% of green power, with the current structure, even if you look at it in the past performance with less than 30% capacity utilization or 31%, 32% capacity utilization, we are delivering a healthy EBITDA per ton. Of course, it would impact 7% reduction in prices would mean it will chop off the EBITDA to that extent. But in my case, the impact is a little lesser only because we have a renewable backup, which is generally not the case in all the other competing cement plants in our region or outside.
Okay. And sir, can you also tell us about that? How vulnerable is the company to coal, pet coke prices spikes before alternative fuels stabilize?
Oh, very good question. So right now we are 100% dependent on fossil fuels like petroleum coke and pet coke. Although the management is considering to look at AFR once our plant stabilizes to a certain capacity, which might take another 2 or 3 quarters. So yes, pretty much most of the cement plants in the country are subject to the variances of this the fuel prices, and is going to impact everyone in a similar manner, except for those who have put up AFR. But also AFR does not replace the fossil fuel completely. I mean, the most successful plant would have reached around 20% of their fuel requirement through AFR. But yes, pretty much as at this point in time, if coal prices very, very high that way, it will impact us more severely than the one who has got an AFR at this point in time.
Okay. And sir, I want to know about ROC as well, the ratios part. If the capacity utilization remains stuck at 65%, then what will be the impact on ROC?
No, right now we are hovering around 31% capacity utilization because we just started our plant this year itself. So at 65%, our return on capital should be significantly higher. I mean, assuming that the prices remain the way we are looking at it right now, nothing has changes. If we increase this thing, our ROC is expected to at least increase by 25 to 30%, and I think we should be in the range of 20% plus. Mainly because again we have a good solar plant. In fact, my term debt is reducing, as I mentioned in my opening remarks. Our term debt is reduced from 188 crores to 159 crores, a reduction in 15%. And very importantly, 3 term loans are getting closed this year. And next year, my repayment obligation is reducing by around 17%. So, as we keep moving, as this debt, which is significantly higher on solar assets, keep coming down, my average cost of power generation will keep coming down, and we will see a very high percentage of ROC, going forward.
Okay, that's great. And sir, can you also explain about that? What contingency plans does management have in place if the plant capacity expansion or ramp up takes longer than expected? Then what would be the approach of management?
So as such, even at 31-32%, if we are able to deliver this kind of an EBITDA, in all probability, even if nothing happens, we will maintain the status quo. Our cash generation will be sufficient to cover all the debt repayment obligations and everything. Having said that, contingency would mean sale of power is not going to stop, irrespective of whether cement goes up and down, because power is a continuous requirement across all the industries, and our production cost last month in January was 1 rupee 30 paisa or so, and it will keep going down by end of FY27. We expect our price of power to go down less than 1 rupee, whereas we are selling at 6 rupees. So we have something, a solar plant which is generating cash, which will take care of any kind of contingency or academic, even if it is. I think we're pretty held up on having that asset which is going to take us through the rough patches. which it has already shown during last couple of years. If you look at last couple of years, even though cement by itself performed very badly, company continued to deliver a certain EBITDA as well as cash profits and covered all the repayment obligations on time.
Okay. So yes, thank you so much, sir, for giving us the insight about much more about the business. So yeah, that's all from my side. Thank you.
Thank you, Raj.
Thank you. A reminder to all participants to press star and 1 to ask a question. The next question is from the line of Vidhi Jain from Apex Capital. Please go ahead.
Hello.
Vidhi, yes, ma'am, you're audible.
Okay. Hi, sir. So, can you break down your receivables between institutional customers and dealer channels?
So right now, as we speak, we are increasing the institutional buyers a little higher compared to Q3. So I think we must have reached about 8 to 10% on institutional buying. Particularly institutional buying means National Highway Authority projects or RMC projects or anything which is directly B2B as opposed to retail. Maybe about 8 to 9% is what we would have reached by Q3, and it seems to be continually increasing too.
Okay. And how do credit days differ between these segments? And has there been any recent change in collection cycles?
Not significant because of aggressive marketing. Our receivable cycle has gone from 13 days to say about 17 to 18 days. That is mainly because of aggressive penetrating into the existing market, kind of offering more little discounts as well as payment terms and stuff like that. But overall, it has not impacted significantly even with this strategy.
So, are you seeing any stress in dealer financing or the need to extend credit terms in the current environment, or have collection days increased in the last 2 quarters and particularly in specific region?
No, southern region itself is showing a little higher collection days, but we are cutting down that in the particularly the new areas of market like coastal Maharashtra and southern Maharashtra, where a lot of development work is happening. The collection days are far lesser, so it is averaging out with the averages moving from 13 to about 17 to 18 days. That's all.
So what is the minimum cash buffer or liquidity level management is comfortable maintaining on balance sheet? And do you have any internal policy in terms of month of operating expenses or debt servicing coverage?
So cash flow as such is comfortable, which is why you could see all the repayments are being done on time. For the debt servicing, once we start reaching 50 plus utilization levels, we're expecting a lot of additional cash flows or residual cash flows, which will go towards impairing the debt ahead of the schedule. That is a plan the management has. We're expecting to improve our utilization level next year. So maybe end of next year or beginning of next year, we will start paying the debt off ahead of the schedule. But management is consistently thought that to reduce the debt whenever there is an opportunity to take care of it.
Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Mahesh Seth from RIV Capital. Please go ahead. Sir, you may unmute your line.
Can you hear me?
Yes, sir.
Yes, Mahesh, we can hear you.
Yeah. Sir, I wanted to know, our EBITDA margin expanded by around 450 BPS in 9 months FY26. So I wanted to know, how much of this improvement is structural versus cyclical?
I would say the significant portion has come by structure only and not cyclical. If you look at year-on-year Q3 FY25, my EBITDA per ton was minus 47 rupees per ton, as opposed to around for Q3 397 rupees per ton. This is excluding the benefits of solar altogether. But if I add solar benefit to the extent of what it has been utilized, my EBITDA per ton has increased from 246 in Q3 of FY25 to 835 in Q3 of FY26, registering a 240% growth in spite of the prices remaining almost flat and also increasing the fuel prices. In spite of the increase in the fuel prices, in spite of my sales price remaining flat, EBITDA per ton increased significantly, which pretty much indicates that structurally there has been a lot of improvement after we put up a new kiln.
Okay. Okay. Okay, got it. And what will be annual O&M cost for a 40 megawatt plant?
So typically we are taking in the range of around 6 lakh rupees per megawatt. So 40 into 6 will be around 2.4 crores per year is reasonable, and we are seeing the same thing in the vicinity of that year on year.
Okay, so 2.4 crore. Okay, got it.
2 to 2.4 crores is what we see.
And how much of solar revenue is locked under long-term agreement?
So as such, the company has not signed a specific PPA with anyone because the solar plants have an incentivized by the government of Karnataka, by which we could sell it in the open access without any regulatory charges or losses. So that strategy has worked out for the management, and we are getting the best price possible in the market. We are allowed to sell almost to every power consumer in the state, which is why we're getting a net realization price around 5.98 rupees currently. Of course, it will change after 2 or 3 years, but for next 2 or 3 years, typically we will be in this range of net realization.
Okay. 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 And can I also know what is degradation rate of solar output per year?
So as per the engineers, the design around 0.7%, but we are seeing around 0.7 to 0.8% degradation happening.
Oh. Okay. Okay. Got it. Thank you.
Sure.
Thank you. The next question is on the line of Vinod Shah from VS Ventures.
Hello, I'm audible?
Yes, Vinodji.
Yeah, hi sir. So what is the break-even capacity utilization for the current capacity?
So with the current capacity, with the kind of solar backup that I have, my break-even point is probably the lowest in the industry, maybe less than 20%. Because even at 30%, we are able to make a substantial EBITDA and, the cash profits. So maybe 20 to 22% is where our break-even point lies at these kind of prices of cement as well as the fuel.
Okay.
And I can tell you easily that we will be the lowest in the industry.
Okay. That's great. That's great. And sir, what is the current capacity utilization?
31% in Q3 FY26.
Okay. And going forward, how do you see that evolving?
So we're expecting to sign off this year by around 40% utilization. Maybe next year we are targeting around 45 to 55% capacity utilization. In case the market still remains compressed or having challenges of overcapacity. If there is a slight pull in the market, there is in every department, if there is an improvement in this thing, we should be able to reach 60% effortlessly. So currently our challenge is not improving the capacity. Our challenge is because the market is very, very competitive. Our footprint is not growing as fast as what we deserve to get. In spite of all these challenges, the negative growth by major suppliers who are south-based here, we are still able to achieve 32% growth, which indicates that had there been a even a normal market, we should have been able to reach 50-60% pretty efficiently. Our cement capacity is not very significant, 1 million ton, and our consumption around the area where we supply is more than 30 million tons. So a slight pull in the market, a slight pull in the pricing would immediately, increase our capacity utilization substantially.
Okay. And let's just say that we achieve those higher utilization, like 60-70%.
Absolutely.
So
Pretty
how much,
easy target.
so how much margin improvement we can see, and how will overall our profitability look?
So with these kind of EBITDA margins, like assuming the same price around 800 or so, with around 60-70%, our EBITDA margin should grow almost by 2 times or maybe a little higher than that, because most of the fixed costs will remain intact, like employee benefits and everything else. Let's say, for example, by 9 months, our EBITDA has come to around 31.5 crores. So maybe this year we'll sign off with 40 to 45 crores EBITDA, which is assuming around 31%, 32% capacity utilization. At 60% capacity utilization, we should be comfortably reaching around 90 to 100 crores EBITDA.
Okay. And sir, how much volume we sold in Q3?
So in Q3, around 78,000 tons we have sold compared to 58,960 tons in Q3 of FY25, registering around 32% growth.
Okay, that's great. And sir, you mentioned the employee cost. So is it do we see any impact of the new wage code? So will there be any rise in employee costs?
No, generally not for cement plants, because cement plants are generally considered to be an assets with a very high capital investment. It's not very labor-intensive plant. The impact is not going to be significant.
Okay. That's all, sir. Thank you.
Sure.
Thank you. The next question is on the line of Manthan Rastogi from Alpha Wealth Avenues. Please go ahead.
Yeah. Thank you, sir, for the opportunity. Am I audible?
Yes. Manthan.
So, sir, in the last calls, we have also mentioned about RMCs. Right? So, are we moving ahead with that, or we will take a look at it at a later part in FY20 or something?
In all probability, I don't think so. We will, look. We thought we could consider it in Q4, but it might take another couple of quarters before we work on that. No, we were expecting cement dispatches to improve in Q3 and Q4 because, looking at the cyclical performance of a cement plant, there should have been an uptick in the demand as well as our utilization. But that didn't happen like expected. In fact, most of the plants registered negative growth in EBITDA in the south and very minor positive growth, 3 to 4% in volumes. So what the management is of the opinion is, we will wait for some more time till we reach, say, at least 50% plus capacity utilization, then look into RMCs. But for the sake of RMC, the company has already purchased the land. We are pretty sure once some positive figures start flowing in from cement vertical, RMC is going to be immediate next step.
Okay. And you mentioned you have purchased the land, right? So what's the amount that we have spent on that? And if any, what is our selection?
Spent on what? Come again with the question. I lost it somewhere.
You mentioned you have already purchased land in RMC.
Yes, we have purchased one land to set up an RMC project in a city called Belgaum. It's in South India, north of Karnataka. So pretty much its population is around 10 lakh, and our corporate office being in this town, we thought we would model the first project in Belgaum so that once the project takes off and the nuance of the business is understood, then we could expand across southern Maharashtra, Goa, and other parts of North Karnataka. But RMC has got a huge future. Currently, we are supplying cement to many RMCs, it would add to our existing sales. And in fact, in future, it would be more beneficial for the company to sell through RMC, because RMC does not have or has got a very minimal price arbitrage difference between the top players or any RMC player. Unlike in cement, where cement brand is visible on the bag, the price arbitrage is pretty significant.
Yes. So, one more question from my end. We have seen a lot of consolidation in the southern market, right, for cement plants. So are we not seeing any price improvements in that region, or you think like that could be the situation once the demand recovers?
The management was expecting the consolidation period is over in Q2 of FY26, Q1 or Q2 FY26. Consolidation is pretty much over, and we were expecting better pricing discipline. But what we have seen is, technically in Q3, the prices should have improved, which has not. If you look at the past history of 3 to 4 years, which has not. So there is an intense competition between the top players to capture the cement, having the cement market, which is why it is causing a price war, particularly in the south region, where which houses the largest capacity in India. So south typically, holds around 30% of the India cement market for production. And
Right.
which is why we would expect some kind of a demand growth in the southern regions, which will immediately turn into price discipline, which is what is needed in this industry right now.
Right. And so, you mentioned in the earlier call also that our location is it's kind of a beneficial for us. So can we sell our cement in Pune region also? Because I think there is a lot of construction that is going in the city and the demand seems to be good.
See, Pune, what happens, even though we are supplying to some peripheral areas of Pune town, the logistic cost is almost around 1,600 rupees per metric ton. But Pune is still a good market. We are opening up over there. Pune, Ratnagiri, Savantwadi, regions of Maharashtra are showing a lot of improvement, because we would be one of the closest cement plants to these regions. And which is why, we are able to easily penetrate. Our nearest competitors are also reaching out over there with a much higher logistic cost. So as we keep moving, we are seeing higher penetration in Maharashtra regions because of being proximity to the area, and that is helping us drive the growth at this point in time. Otherwise, depending purely on southern-based market would not have allowed us to reach this kind of a growth.
Right. And as we've increased the capacity, are we seeing any issues in procuring limestone as we do not own any mines?
Not at all, because we are the only purchasers of limestone in that area with around 20 to 30 suppliers. So at this point in time, we are well poised with limestone requirement and the availability of the basic raw material.
And even if we move to maybe 70% utilization, you do not see any issues with limestone?
Not at this capacity, not at all.
Okay. And are we also looking at mixture cement like PSC, where we mix slag or fly ash, etc.?
We are, in fact, most of our cement goes in PSC sector only. So PSC is the order of the day. Almost all the cement plants supply most of the product in PSC format only. OPC format is used only by specific requirement, say for RMC or cement articles. Otherwise, pretty much for all the projects like National Highway or the grand scale projects can go with PSC, which is what we are supplying with right now.
Okay, so from where we are buying slag or fly ash?
So fly ash we are purchasing from one thermal power plant near our cement plant, which is known as the Raichur thermal power plant. But fly ash requirement is not very significant. Slag we are buying from Kalyani, JSW. There are 2 or 3. Plus we have supplies from Goa also. There are 4 to 5 people, or even from Vedanta from Goa. So we have 4 to 5 sources we are purchasing slag from.
Right. Thank you so much. No more questions from my side.
next question is from the line of Tushar Talwar, an individual investor. Please go ahead.
Hi, can you give me a Hi, can you give me a breakup of the debt repayment schedule and what are the quantities and when it's happening?
So the debt repayment schedule is what you're asking for?
Yes.
So FY26, our obligation is around 29 crores, out of which almost 24-25 crores is already done, taken care of. This, or not, 26-27 crores already repaid, another 2-3 crores by next month in March. In FY27, our debt obligation is about 23 crores. In FY29, so in the next year, the debt depreciation is about 90 crores. Typically, mainly because 3 terminals have closed down this year or will close down this year. Another one will close down next year, and it keeps going from that point onwards.
All right, sir. Thank you so much. That's all from my side.
Thank you.
Ladies and gentlemen, you may press star and 1 to ask a question. Ladies and gentlemen, we take that as the last question of the day. And now I would like to hand the conference over to Mr. Harshal Ghanshani for the closing comments.
Yes, thank you everyone for joining the conference call of Shri Keshav Cements and Infra Limited. If you have any queries, you can write us at research@kirinadvisors.com. Once again, thank you everyone for joining the conference call.
Thank you, everyone.
On behalf of Kirin Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.